Gotta do this. Do this. Make sure I spelled that right. Cool. All right. Thank you everyone for tuning in to the Nailed Pitch. My name is Carl Ponto, owner of Squash and Stretch Productions. And this show is all about helping founders of startups understand what VCs and investors are looking for when pitching your business to them. So I'm super excited to have Zamir Shukho. He's a GP at Vibranium VC, and he has a ton of super valuable information to help founders know how VCs, how investors look at the investment process, what they care about, and what some of the metrics are that you need to know in order to increase your chances of getting funded and helping your company grow. And once you're funded, understanding what's the relationship going to be like with your investors, with your investment team. So thank you so much for being on the show, Zamir.
Yeah, thank you for inviting me, Carl. It's my pleasure. I'm always happy to share some of the VC wisdom with startups because it makes the journey much easier for everybody.
Absolutely. Yeah, it's I'm amazed at how many mistakes that startups make, founders make, and it's like how with some simple research, simple communication, it can be way easier for them. So I know you showed me some amazing slides, amazing information. What is kind of the biggest mistake or biggest challenge you see founders make when they go into the fundraising process, and what are some tips you have to help them avoid those issues?
So one of the biggest challenges, I don't really like the word mistake because, building a startup is a journey of making mistakes and, finding your way, and mistakes actually make us better and makes us stronger. So it's good, it's okay to make mistakes. But the challenges that I see a lot of times that startups, especially because we have such a big and broad network of accelerators that, teach that you need to prepare a good pitch. Good pitch is great, but you have to understand, guys, when you are in a conversation with an investor, a pitch is only a first step to get you through the door, to get some kind of an interest. And a lot of times when we conduct the due diligence process with startups, they're missing a lot of information that is needed for us to analyze if this company, if this startup is good, if this technology is strong, if this team is capable of pulling this off. So they have a good pitch, they have nice slides, but this is only maybe 10% of the whole journey by the time you close the deal with an investor. You need a lot more, and we'll talk about this today. So the common challenge that I see is that startups focus a lot on their pitch, and they focus a lot on the slides, and then the rest 90% of the needed information and documents is either missing or in a very bad shape. So I would say, the balance has to change. Even though accelerators tell you, hey, prepare for the pitch, do the demo day, the journey, it's just like in those Hollywood movies. Like everything about the movie ends during the wedding, but the real life starts after the wedding. So here, the presentation is just the piece that, allows you to get into the door, into the office or into the next meeting. But then you probably will have 6, 7 more meetings with the same investor talking about deep stuff, your financial models, your technology, your go-to-market strategies, and many more things that should be also prepared before you start your fundraising.
Yeah, it's definitely the idea that you'll pitch once and get funded, they'll write you a check right away, just it's a complete myth. And so I remember you when we were kind of doing the prep for this, you showed me a slide of kind of the priorities for what you want to know about from an investor or from a startup before you'll feel comfortable investing. You showed me there's some like 6 T's. Can you pull up that slide and show? Because I think that's something that the majority of founders aren't prioritizing those
Yeah,
things the same way that
absolutely.
you are, so that it can be super important.
So there's a 6T methodology that was created at Stanford by some of my friends that have done a big research, thousands of deals, and they were asking and looking for what was important to VCs, what they were looking at, and what they were evaluating or scoring while conducting due diligence process. So they positioned these things in the order of importance, which number one, the most important thing that VCs look at during the early stage investments are, basically the team. Do I believe that this is an A team, that these guys are future champions? Do they have enough experience? Do they have the track record? Do they have other businesses that they either exited or failed, which is also okay. If you had a failure in the past, you've learned a lot of things. So number one is always the team. Number two is the market. Is this market big enough? If it's a $1 billion market, maybe it's not big enough. 5 billions and up is also always good. $10 billion market, great. But again, whenever startups show these numbers during their presentations, they take some crazy big numbers saying, well, the whole market of advertising is, $500 billion. But you're not, working on the whole market of advertising. You're doing the mobile apps, game advertising. You got to narrow things down. So calculating this is also important to do it properly. Then the third level is technology, right? Investors want to make sure that whatever you're using for building your product is not an obsolete technology. It's something new, it's something trendy, it's something that is disruptive, and on top of that, the business model that you're using is also not outdated, and for sure it's going to be there for many more years ahead. Then the next thing is the traction. When we talk about seed stage, I will show you some additional numbers. I have some slides, like what kind of traction do we look for? For example, when we say, okay, it's a seed stage startup, you already have to have some kind of revenues, right? $10,000, $20,000 a month revenue, 30, 40 sometimes, to raise your seed stage. If you are a pre-revenue startup, most likely you are a pre-seed stage, and you need maybe $500,000 to $700,000 to get some traction showing. So one of the most important metrics in traction is the revenue, because revenue proves that you have a product market fit. Usually investors say, if you hit $1 million a year in revenues, then you have a product market fit. Anything before that, you're still experimenting, you're still looking for that right customer, that right segment, etc. Now, the next is trends. This is about, are you going along with current trends, or are you trying to go against the current? Especially was very obvious during the COVID, when people were trying to do different startups during the COVID that actually, would not grow during the COVID. And after the behavior changed from the customers, trends changed. People started doing remote work, people started commuting less, people did a lot of more shopping online, etc. So it changed the behavior. And whenever you're doing your startup, you always have to look at the trends and make sure that you are aligned with the macro shifts, right? There's a war in one part of the world. Are you considering that? There is an economic downfall right now. Are you considering that? So trends are important because these are big waves that either can take you as a surfer with a big speed, or can actually, come on top of your head and drown your company. And
if you're launching an event planning business at the beginning of the pandemic,
I know, exactly.
It's just not going to fly.
Yeah.
And so continue the last one.
Yeah, the final one I want to mention is the terms. So, whatever you offer, the size of the round you're raising, the valuation cap that you're trying to go with, the way you want to do it, safe notes or CLA or SLA agreements, whatever. So it's the terms that you're coming with to the investor, and they're saying if that fits their generic approach to deal structuring. But I would say this is last out of all the previous. Now, if some of the previous things look weak, a lot of times investor wouldn't even look down to the next level. So say, hey, if you don't have enough traction, I'm not even going to look at the terms. You don't have enough traction, come back later. So yeah, just to give you a little heads up on that.
Yeah, I think that's super, super valuable, because so often, I mean, one of the biggest mistakes or biggest challenges of in the pitches even is that they focus so much on the technology and the features and the product itself, and they don't have enough about the team or how they're like the market. Like I said, they're really understanding who they're selling to, if there's a real fit there.
Yeah, when it comes to the choice between a strong or cool product and a strong team, I will always go for the strong team, because a strong team can pull off even a mediocre business model and can make their product better by pivoting, by experimenting, by going out there, talking to the customers. And I've seen so many times that a great product or a great idea that was put together as a product, the business was never built around it because the team was not capable of doing it. And this is eventually what investors are looking for. It's not just the cool product or the cool idea that you're tackling. Is, are you capable of building a sustainable business around that product? So if that's the case, if you show that you have traction and you've done this before, or you have really amazing team that can pull this off, then yeah, the belief is higher, because in the seed stage or pre-seed stage, is not too many metrics that we can really measure, right? So we have to rely on some other maybe soft skills, let's put them that way, that we believe that, hey, with this skill set, with this number of people in the team, with this experience, they will eventually make it happen.
Yeah, and it seems like to me the startups aren't focusing enough on like building like the brand traction and like the community around the business, get that income coming into their actually a proper seed stage company, and just being able to show that they care enough about the topic, or care enough about the problem they're trying to solve, that it's not just a, oh, I have an idea for making a bunch of money. It's this is something that like I am and this whole team are committed to, and we're going to stick it through. We're not going to give up when things get tough, and we're going to put in the hard work and the long weekends and stuff like that.
Yeah.
And I think that's something that there's this mindset that founders have, because they're so used to being like the engineer or the scientist or the researcher, and now they're trying to transition to leader and entrepreneur and founder. There's a whole new set of skills they need in order to make that successful.
Yeah. So one of the key things I always talk about when we discuss, with startups, what is important is the motivation of the founding team. A lot of times this is neglected, but to be honest with you, I've seen so many times that during hardships, and you will hit hardships in your startup, you will, fail many times, you'll get denial, you get no, customers would not want to look at your product, etc. So during the hardships, the motivation of the founding team, of the founder, is the key to success. What drives you forward? Is it just making money, or you have a bigger mission, or you have a personal attachment to this product or to this problem? When you have a personal attachment, when you have a story behind why you want to solve this problem, either something related to you, your relative, your child, the community that you represent, then the belief that you will do whatever it takes to make this a success is much higher. But if you just come in here, saying, hey, I just see a good opportunity to make money, well, that motivation might not be enough for you to struggle, because, hey, there's many other ways to make money rather than, working 80 hours a week, weekends and no vacations for 5 years. So
yeah, if you're trying to get just a quick payday, starting a startup is not the easiest way to do that.
No, it's not.
And so what sort of, so that's kind of the team aspect, which I totally agree is something that is absolutely essential, is that mindset. What sort of things you recommend early stage companies do to show, or like to get some traction when, even if like they're pre-seed? Give me suggestions of things you've seen other startups do that really help them prove they have that traction, that makes their kind of the plan for going to market and the proof that people actually care about this thing really clear to you as an investor? So what are some of the recommendations you have for getting that traction?
Yeah, so there's a couple approaches to to doing things, and what I've seen in the past. Sometimes the founding team would come up with an idea, would start building something, a prototype, etc., and they would love the product so much, and they would sit in the office and keep building the product for a year, and then by the time they take it to the market, nobody would really care about it because they never talk to anybody on the market. So these approaches, they were very popular before. Now everybody is saying, okay, before we even start coding, let's go out there and talk to our potential customers. Let's ask them questions. Let's see if this pain is really hurting them enough so they would pay for a solution, right? Let's ask them what kind of motivation they have behind these situations, what kind of feelings they have. So let's try to dig deeper into the situation of our potential customers, so we understand what kind of features we need to build first in our MVP, etc. Because you don't want to build a space station right away. You want to build a quick product, like an MVP, and you want to start testing as fast as possible. So one of the key suggestions would be, first, try to locate your potential customers, try to ask them questions, interview them, because you will find out a lot of information from those interviews even before you start creating a product. And that is important. Then whenever you figure out the problem, you gotta understand whether it's a red ocean or a blue ocean. I mean, yeah, the problem exists, but there's so many players in that field that it will take you enormous resources to penetrate that market, to become another player, like another e-commerce store. There's so much e-commerce out there. If you come to an investor saying, I want to make another store that sells this type of product, most likely investors would not be interested. So it has to be something interesting, disruptive. It has to be a market where you have a chance being a startup. Now, when it comes to skin in the game, I like to see that founders have invested some of their own money in it. It doesn't have to be a big amount, $30,000, $50,000, sometimes $100,000. But if founders invested their own money as step number one, then I have a higher belief that they will care about this project. Not coming to me, with just a simple PowerPoint saying, hey, give me $1 million, I'll do everything. Well, okay. Sometimes people just want to get salaries for the time being, and they eventually fail. So whenever there's a skin in the game, it's a good factor. It's a green check, right? To say, oh, okay, they did invest their own money. And then before you approach professional investors, it's always good to have a group of maybe business angels or friends and family who also believed in you, also invested some of resources into you, like on a pre-seed stage, helping you build your basic MVP. Because whenever you come to professional investors, they will ask you heavy questions, and they will put you through a due diligence process. And if you did not complete previous steps, if you did not invest yourself, if you didn't attract any business angels, if you didn't go through an accelerator, it will be much harder for you to raise from a professional VC or a seed stage fund.
It makes a lot of sense that there's these phases, or there's this process to basically prove that you're taking this seriously, you're doing it the right way, and you're not.
Yeah. I even have a little picture I can share how it looks. I'm sure some of you have seen this before. This is about the stages, right? And just as you mentioned, Carl, it's important before you get to a VC, you see it's right here. Before you even get to a VC, it's important that other people believed in you, like somebody invested, like friends and family here, and business angels here, you see with the little angel thing. So other people, other organizations like accelerators evaluated your company, evaluated your technology, they believed in you, you have a stamp of one of the top accelerators that you've passed, because VCs, they don't really want to work for you, right? For the founder. They want to invest in you, give you resources, help you with networking, but they don't want to do your job as a founder. They don't want to run your company. So keep that in mind whenever you are looking for a VC. Of course, everybody wants smart money, which is good. You want an investor with some experience in the field, with some connections in the field, but the job is still going to be done by you and your team. Investor is just only to support you, help you, give you advice, or give you a contact. So the investor wants to make sure that you've done this work with somebody else before on earlier stages. If you evaluated the idea, that you went out there, that you have your first traction, that somebody helped you already and believes in you already by the time you get to a professional VC right here.
Yeah, it makes a lot of sense. And it really helps this is super valuable, because I think just part of what a lot of founders do that causes them difficulties, that they just think about things from their own perspective. They don't put themselves in the shoes of their clients or the customers. They don't think about it from the perspective of the investors or the VCs. They don't think about what is going to motivate them, what's going to inspire them to say yes to either buying or investing. And they, like you said, you mentioned earlier, like they get too focused on, let's make a perfect product. But if it's just perfect for you guys, you're not selling to your team, you're trying to sell to other people, and you got to put yourself in their shoes and really understand where they're coming from. And I think that slide there was another great example of just understanding how many other people you have to get involved at what stage, and be able to demonstrate to them that this is a legitimate thing, and show you're committed to it and have a reason for it besides just a money-making opportunity sort of thing.
Most of the investors out there do not have technical background. So they are usually people from the financial sector, people who already made their money, serial entrepreneurs, etc. Like myself, I'm a serial entrepreneur. I'm not a programmer, I'm not an engineer. I do understand technology, but if you ask me to look at the code, I would not be able to verify. I have special people to do that, to verify if this code is good or not. But eventually, my big question to you would be, does this work? And if it does, good enough for me. Now show me the business model around it. And I would definitely urge startups to learn more about how venture funds operate. What is the motivation of the venture investor? What is the business model of the venture fund? Because if you don't understand how we operate as investors, you don't know our motivation, then it would be very hard for you to build a dialogue with us, because you have your own perspective, like Carl mentioned here, and you think, or you believe that, hey, if it's an amazing product, then why don't everybody invest? This is so great, so amazing. But this is your baby. You have to understand. This product, you've built it. It's been a year or 2 years of hard work. But for me, it's just another startup, and I see 10, 15, 20 startups a day like that, similar to you with other founders. So for an investor, it's always a choice. Do I believe these guys or these guys? So where do I put my money in? Which horse do I bet on? Like, which horse I believe is going to be the champion, right? So there is nothing personal in the beginning before there's a relationship. So it's always good to understand the motivation behind what investors are looking for, and really dig deeper into the business model of a venture fund. So you figure out, okay, I have to hit these milestones. I have to show an exit strategy. I have to perform to these KPIs for the investors to even consider putting money into me, and consider me as a good startup, a potential champion.
That's amazing advice. And how much time should founders give themselves to do that research? I was with a previous guest, they were talking about how it's important to reach out to and start building relationships with like a Series A VC way before you need the funds, just knowing, hey, I'm going to build the trust and connect with people. So when you are ready for a Series A funding, it's not a brand new relationship you're trying to build. So when it comes to doing the research and getting to understand the business model and understanding what a certain investor, the way they think, what they look for, how much time should founders give themselves to get that done, so they're not trying to rush in the last minute when they're suddenly like, oh, our funds are running out, we need a Series A, let's start looking at people. Like, you should be looking how much sooner before the funds run out, sort of.
So a common mistake would be to start fundraising like 2 months before the funds run out. That's not enough money. Sorry, that's not enough time for you to close a seed round. Usually it takes from 3 to 6 months because you will have to conduct maybe 50, 60, maybe 70 meetings with investors in order to close 3, 5 of them, to invest in you. So this is a full-time job for a founder and maybe somebody else to help them. And you gotta have a large funnel, of leads, just same way you do with your sales, right? Like when you sell to companies or corporations, the fundraising process is similar. So you have to have a funnel of maybe 200, 300 contacts out there that you're going to reach out, that you're going to write emails, that you're going to try to reach on LinkedIn or find them on different events. So I would definitely put 3 to 6 months in order to do that when you're doing your seed round. Now, when you already in a good shape with your seed round, you've raised more than 50% and you keep going, you have more relationship, it is a good time to start slowly finding the Series A investors, even though you understand that your Series A will happen maybe 12 to 18 months from your seed round. But whenever you start talking to them, saying, hey, I know I'm too early for you guys, but I would like to just connect and maybe keep you updated. And a good thing to do here would be to send the regular updates, build a little mailing list of your Series A investors and send them updates. You don't have to do it every month. It might be too much, but maybe every quarter, sending them updates saying, hey, I'm doing much better. I've completed my seed round. I'm growing, month to month, 15%. These are my traction, new customers. I took this competition. I completed this accelerator. So you show them and you build that relationship and trust, and you show that every time you send them a new update, you're doing better and better and better. So you kind of build the appetite before you approach them with a specific, Series A terms. You already built an appetite that you are a good and fast growing team, and you are doing something interesting, you're amazing, you have good traction, etc. So I would say start right as soon as you either complete your seed round or during your seed round, you already start building those relations, because we as seed investors, we have the relationship with the Series A. And we are happy to introduce our portfolio company to those guys as early as we can. But it's always good that these startups already know these investors, and then we just do a reference. We kind of do a warm intro saying, hey, these guys are our portfolio company. Now you already know them, but now you have, us also being in the game, right? Also taking the risk, and us, etc., etc. So it's always good when there's more people referencing to the same startup, and it helps you build this warm relationship. So by the time you are fundraising, by the time you come to them with a real proposal, they already know you, they've seen your traction, and the belief that you can actually pull this off is much higher.
Yeah, it makes a lot of sense. It's like building any sort of relationship is going to take time, and if you do it the way you just described it, it solves that, like, the team, or there's a team qualified to help basically answer that question. Is there the traction? Is there the TAM there? Like, they can basically prove to the investor before you ask them for money that these red flags are looking for, you've already got that handled, you've solved these problems, you're working through it. And so it's not just they have way more evidence that you're a better bet for what startup they should go with. Yep. Because you're giving this evidence early and regularly and showing improvement, and it's much easier to do it that way than try and hurry in the last couple months to find someone cold.
Building that relationship early allows you to get feedback of expectations. Like, when should I come back to you guys? What kind of metrics are you looking for? And I will show you the table If you want, I can do it now,
Sure.
just to go over these things. The expectations of investors on different levels. So this is something that our team has put together. It's a table, you know, if you're raising your seed round. So these are the expectations that will happen during the dialogue, right? So we expect that the company is not older than 3 years. So if you are older than 3 years and you're just raising your seed round, that means you've been kind of slow growing for the past, periods. Now we expect that you have a 300 to 500% growth for the last 12 months, meaning revenue growth. So this is, very good speed, right? And if you grow only 100% a year, you might not be considered a venture startup, even though you have a technology. But the word venture is about the J curve, is about the very fast growth. Now, we would expect you to have at least $500,000. So the median here is $500,000 in revenue, in annual revenue, by the time you try to raise your seed. If you have only 100K and you're trying to raise a seed round, you might be a bit too early. So a lot of funds will tell you, hey, come back later when you have close to $500,000 annual revenue, and your valuations would be close to $10 million at that time. So this is what we see a lot when startups exit accelerators and they can show some traction, some revenues, and they're like, oh well, we're close to 10 million. And very important at this point, when you look at the multiples, even though not many metrics to measure, but at least if you have a revenue and there are basic multiples, these are multiples for SaaS products. Like median multiple is 18x, which is good because I've seen 8x, I've seen 10x. Now markets dropped, but sometimes startups come to us and they're like, this is our traction. We make 200K and our valuation is 10 million. Well, if you make 200K and your valuation is 10 million, that's 50x. And that's very tough to pull, guys. 50x multiples they don't exist. I mean, if somebody believes in you and just gives you money, I would consider those people non-professional rather than professionals that I should rely on their opinion while doing my due diligence. So keep those numbers in mind. This is what you can really, maybe 20x your revenue times multiple would come up with the valuation. So, really try to have proper expectations on these numbers of what professional investors would really consider as a fair value of your company during the seed stage. Now,
actually, it was just I had a talk with a startup founder earlier this week who said that he was pitching a lot and wasn't getting any bites, and then he dropped his valuation by, like, he halved it into something a lot more reasonable. All of a sudden, boom, people were like, oh yeah, that seems like reasonable valuation. Let's talk more. And he's getting more second meetings and stuff now. But it was just that valuation he had was unrealistic, and so that was just throwing up these red flags, and people weren't wanting to move forward. And he was at, man, I can't believe all it took was lowering the valuation that I put on the pitch, and all of a sudden I'm getting all these people interested.
Yeah, because one of the deal breakers is the valuation. That's what we talk about in early stages of our due diligence process. If we see the traction, and we use 5 different methodologies to evaluate a startup, and we are not interested in dropping this valuation down too much, but we want this to be a market standard. We want to make sure that us and other investors will consider this a fair deal, because whenever we come in, so let's say your round size is 1.5 or 2 millions on the seed stage, we can put in 500K. So there's another 1.5 million that you need to raise. So if we put in under high valuation, if we say, okay, fine, we agree, this is higher than the market, but we'll go because we like the founder and the technology. How many more other investors will say that? Because we want to make sure that you do complete your fundraising, that you do get the resources you need to get to the next stage. So we want to make sure that you understand what the market is right now, because we as professionals, we scan these data points on daily basis. I mean, I got a whole team looking at reports, the come out. What are the multiples now in this market, etc. So we always adjust these numbers, but startups, they don't have much clue about how to evaluate themselves. So they're like, oh, we believe that we're worth 30 million with with $100,000 revenue. Like, no, you're not. Sorry, guys. No matter how much you love your product, this is a market where there are certain rules, and you have to know these rules. That's one of the reasons we created this table, and I show it to the startups sometimes to make sure that they understand the rules of the game. And these like speed of growth, how many years you existed, how much money you've raised before. If you raised more than 1 million on your pre-seed stage, that means you've raised too much. That means you've given up. If you, for example, if you come to us on your seed stage and you have less than 75% of equity, even if you're like with convertible notes and loans, etc., if by the time you convert everybody, you will have less than 75% during your seed, that means you've raised too much. You've given up too much of the equity in the company. So these things we do look at as professionals. You should, be careful about how much money you take when you're early stage, because you can dilute yourself too dramatically, and by the time you get to Series A, Series B, you will lose the control of your company, and then you will be non-investable. So this is a long-term game. When we look at you now, we try to see, is this team going to make it to the next stage? Are they going to make it to B? Are they going to make it, further down, all the way to the exit? Because for us, the final result of this deal is exiting out of this deal. It's not just helping you get to Series A. It's helping you, go all the way through. And if we see that already now with this basic numbers that you have, you will not be able to make it, most likely we will say no to the deal.
Yeah, I think that's super important for founders to understand the long-term game or the long-term stages that they have to keep in mind as they're just trying to get that next round of funding, because it's not just about one round, it's about how that impacts all the other things. So I think that this table is chock full of super valuable information so they can understand what they need to do when they're getting their either like angel or pre-seed stuff, so that it's all, so it basically sets the foundation for that next stage, and not just look, we got some money so we can keep going, but like you kind of invested your way into a corner almost because your terms of the first deals weren't what the next stage investors is going to find appealing. So that's super valuable.
This is a long-term game. Let me give you a couple more things that are important to consider. Now, when you raise your seed round, we want to see right away how you're going to get to your next round and when. So right here on the bottom, there's the future revenue that is expected for you to have by the time you raise your Series A. So if you say, okay, I need 2 million now, which will give me 18 months runway, and I have $500,000 revenue now, you need to get to 3.6 million revenue in order to be eligible for a good Series seed, right? So that is a good growth, right? Like almost 5x within 1 year. If you do not have a plan supporting this growth, I mean, don't put these numbers just in the Excel spreadsheet, guys. If you have those in an Excel spreadsheet, okay, yeah, I might believe it, but you'll need to have a supporting marketing and sales strategy saying, okay, this is my pipeline. This is where I'm going. This is how much I'm going to sell every month. This is how much I'm going to grow every month. I have the team to do that, or I'm going to hire so many salespeople to do that. In SaaS business, you got to have a salesperson for every $500,000 of revenue. So you need 7 people, to be able to attract this kind of a revenue into your company. And one other thing that startups are missing or not even considering, the capital consumption ratio. What is the capital consumption? If you're taking 2 or $1.5 million, we would expect you to create $3 million of new revenue with this. So basically, one investment dollar equals $2 in new revenue. That's a good capital consumption ratio. If you say, okay, I'm gonna take 1.5 million now, and my revenue next year will be $1 million, that's not good. So you're not making the proper ratio for capital consumption, where we consider this a good business model, or a team that can actually, create 2x revenue to every dollar they got from an investor. So these ratios, please keep them in mind. All of this really matters, because whenever you talk about your startup, you do talk a lot about the technology and the features, etc. But all I'm showing you right now is about the business, right? It's about how you're going to make money doing what you're doing, and make it in a sustainable way and repeatable way. Recurrent revenue. Whenever we talk about software, especially SaaS, we want to see recurrent revenue. So all of these numbers, this is recurrent revenue, which keeps growing. It's not just contract once. It's not just one sale. It's repeatable monthly, quarterly, annually revenue.
Yeah, so we're almost at time. You had one more slide you showed me about, I think it was really important, about kind of the timeline for a relationship with an investor, kind of what when you break even, that sort of thing. What's kind of the expectations investors have when they're investing in a startup as to when that break even point is. Let's show that, and then give me one more big takeaway you think founders need to know, and we'll wrap it up.
So the J curve, right? This is what we call it, the venture capital J curve. So the first years of your company, you will be taking more money, and so basically you'll be going down. Somewhere around here, you'll start, making revenues, and then it starts building back up. And right here is the break-even point of your growth, and then from there, it's growth and harvest. And when we mean harvest, it's startup can potentially exit or be sold to a large company, PE firm, or strategic investor. So we expect that our journey with a startup will be at least 5 to 7 years, maybe 10 years. So this is a very long-term relationship, and we want to make sure that you will not only survive through that time, but also grow rapidly through that time. So the due diligence process that we have, all the questions we ask, all the numbers we look at, is for us to try to predict. This is a lottery, a little bit of try to predict whether betting on you, betting on your team, betting in your startup will give us the 10x, 20x, 50x return in 5 to 7 years. That's pretty much how it works.
Awesome. Well, thank you so much for being on the show. If people want to reach out to you, if they want to talk to you more about investments in VC and kind of the startup experience, how can they reach you?
LinkedIn. You can find me. I'm the only Zamir Shukho there. So reach out, join my network. Let's talk. I'll be happy to help.
Awesome. Thank you so much for being on the show, Zamir, and have a good rest of your week.
Thank you, Carl.